One company, growing revenue at 14% year over year, still trading below book value as of May 2026, and 4 others sit in the same shadow. Here's what you'll leave with in the next 12 minutes. A working framework for finding stocks the crowd is mispriced, demonstrated on 5 live names with real numbers, real catalysts, and the specific reason each one is cheap right now. The gap between price and cash flow is where retail investors actually win. Quick question before we go deeper. When you last bought a stock, did you check whether it sat inside a crowded trade or an empty one? Hold that answer. By block 3, you'll see why it matters more than the ticker itself. Most retail investors think mega cap concentration is just a vibe. It's measurable. By late 2025, the top 10 S&P 500 names accounted for roughly 38% of the index's weight, according to S&P Dow Jones indices, a level not seen since the early 1970s. When money flows pile into the same handful of tickers, the pricing engine for everything else gets thinner. Thin pricing means slower information absorption. A small cap industrial that posts a clean beat in May might not see its multiple adjust for 2 quarters because nobody's actively modeling it. The crowd is busy arguing about one chip designer. For you, this is the structural edge. Empty trades reprice slower than crowded ones. That delay is the window. This week, pull up the 10 largest holdings of any S&P 500 ETF you own. Then count how many of your individual positions overlap with that list. If the answer is most of them, you're not diversified. You're concentrated twice. Compare 2 companies. One sells subscription software with a recognizable brand. The other sells tungsten carbide cutting tools to aerospace machine shops. Both grow earnings at roughly the same rate over a full cycle. The software name trades at 30 times forward earnings. The toolmaker trades closer to 15. That's the boring industry discount, and it's persistent. Research from Cliff Asness and AQR going back 2 decades shows that value spreads widen most aggressively when narrative-driven sectors dominate flows, which is exactly the 2024 to 2026 setup. The consequence is direct. Unsexy cash flows pay the same dividends as exciting ones. The dollars don't know they're boring. Build a 1-page filter this week. Companies and industries you'd never bring up at dinner, trading below their 5-year median price to sales, with revenue still growing. That single screen will surface more candidates than any hot stock list. Picture a nurse driving to a medically complex child's home in suburban Phoenix on a Tuesday morning. She's one of nearly 30,000 caregivers working through Aveanna Healthcare Holdings, ticker AVAH, across roughly 350 locations nationwide. The company raised full-year 2026 revenue guidance to about $2.4 billion, with home health episodic growth running at 14% year over year. So why is the stock cheap? One number explains most of it. Roughly 82% of Aveanna's revenue flows through Medicaid reimbursement, and the market treats that as a permanent overhang. The setup is more nuanced. Hospital stay costs have roughly tripled over the past 2 decades, per CMS data, and both Medicaid and private insurers are aggressively pushing care into the home to cut spend. Aveanna sits at the intersection of those 2 pressures. The discount is for the payer mix, not the business. Before you act, read the last 2 earnings transcripts and note every state rate action mentioned. That tells you the actual risk, not the headline. Kennametal, ticker KMT, makes the tungsten carbide cutting tools that machine the parts inside jet engines, oil pumps, and defense hardware. 87 years old, deeply unglamorous, and posting 10% year-over-year sales growth in its most recent quarter, above its own guidance. The catalyst worth watching is broader than the company. The ISM Manufacturing PMI, the standard gauge of U.S. factory activity, turned positive in early 2026 for the first time in roughly 12 months. Aerospace, defense, and energy customers, Kennametal's 3 largest end markets, historically lead capital spending cycles by 1 to 2 quarters once that index crosses 50. Kennametal also just integrated with Hexagon's cloud-based tool library, modernizing how machine shops source and track tooling. The consequence for you is that this is a cyclical inflection trade, not a story stock. Buy the inflection, sell the euphoria. Track the next 3 ISM monthly prints before adding. If the index rolls back below 50, the thesis pauses. If it holds, you're early, which is the only place worth being. How do you stress test an overlooked thesis without spending a weekend on it? Start with one question. What does the market believe that I think is wrong? Write the answer in 1 sentence. If you can't, the thesis isn't ready. Next, run 3 checks. First, look at insider transactions over the past 6 months. Open market buying by officers, not pre-planned 10b5-1 sales. Second, read the most recent 2 earnings calls and count how many analyst questions probe the bear case case directly. Heavy bear case questioning means the discount is already priced in. Third, check short interest as a percentage of float. Anything above 15% means the crowd is leaning against you, which sometimes is the trade and sometimes is the warning. That's the whole routine. A thesis you can't summarize in one sentence isn't a thesis. Apply those 3 checks to one stock on your current watch list before the week ends. If it survives all 3, it earns a position sizing conversation. Quick pause. If the framework so far is useful, the next half is where it pays off. The remaining 3 stocks each illustrate a different mispricing pattern, and the next section covers the single mistake that catches most retail investors when they try to buy cheap. Subscribe so the follow-up on sector rotation reaches you, and drop a comment with which of the first 2 names you're most skeptical of. I read those. A specialty manufacturer in Richmond, Virginia spends most days making aluminum extrusions for window frames and polyethylene films for specialty packaging. Tredegar Corporation, ticker TG, trades below book value and at less than half its annual revenue as of May 2026. The market is treating it like a struggling operation. The cash flow says otherwise. Revenue, earnings, and operating cash flow are all accelerating across the last 4 reported quarters, with margin expansion in the aluminum segment driving most of it. Analyst coverage is sparse. Fewer than 4 sell-side firms publish on the name, which is exactly why the gap persists. Undercovered stocks reprice slowly, then suddenly. The risk is real. TG is capital intensive, and aluminum input costs can squeeze margins fast if commodity prices spike. Cheap and accelerating is rarer than cheap alone. If you're considering TG, pull the segment level operating margins from the last 4 10Q filings and chart them. If the line slopes up, the thesis is working regardless of where the stock price sits today. Here's a pattern most retail investors miss entirely. When property and casualty insurance carriers absorb catastrophic losses, wildfires, hurricanes, the inflation shock of 2022 to 2024, the first line item they cut is customer acquisition marketing. That spend doesn't return on a smooth curve. It returns in a step function once underwriting profitability is restored. Media Alpha, ticker MAX, runs the technology behind a large share of online insurance comparison shopping. Revenue collapsed during the carrier pullback, and the stock fell with it, down roughly 25% in the 3 months ending May 2026. 2 consecutive quarterly guidance raises plus an expanded share repurchase authorization suggest the cycle has already turned. Management doesn't expand buybacks during a downturn. This is the recovery cycle lag in plain form. Marketing budgets return faster than analyst models update. Set a calendar reminder for the next P&C earnings season and watch for carrier commentary on customer acquisition spend. That's your real signal, not Media Alpha's own guidance. Picture a couple in Quebec walking through a power sports dealership in spring 2024. They priced a Sea-Doo at $15,000, a Can-Am side-by-side near $25,000, and walked out. Not because they couldn't afford it, because inventory was bloated and they expected a better deal in 6 months. BRP Incorporated, ticker DOO, owns Ski-Doo, Sea-Doo, Can-Am, and Lynx. The post-pandemic inventory glut crushed the stock to a 52-week low in 2025. It has since roughly doubled. Shares trade near 0.8 times sales, a fraction of the historical norm closer to 1.5. International order book momentum is rising, which structurally reduces dependence on North American consumer cycles. The mistake is treating this as a recovered stock. A double off the low isn't the top, it's often the middle. Before sizing a position, check the next U.S. consumer confidence reading and dealer inventory data from the major power sports trade reports. Both have to keep cooperating for the upside case to extend. Compare 2 stocks. Both trade at 8 times earnings. One is a regional bank with declining deposits and shrinking net interest margin. The other is an industrial supplier with rising free cash flow and a debt-to-equity ratio under 0.5. They look identical on the surface. They are not the same trade. That confusion is the most expensive mistake in value investing. The fix is 3 filters applied in order. First, is free cash flow growing over the trailing 3 years? If no, it's not value. It's a melting ice cube. Second, is return on invested capital above the company's cost of capital? Below it means the business destroys value with every reinvested dollar. Third, is the balance sheet clean enough to survive 18 months of stress? Net debt to EBITDA above 4 is a red line for most cyclicals. Cheap without cash flow is just a slow loss. Run those 3 filters on every name in this video before you buy a single share. Here's what to actually do this week in order. Pick the 2 stocks from the 5 today that most fit your existing portfolio gap, not the 2 with the highest implied upside. Upside is a forecast. Fit is a fact. Next, size each position at no more than 2 to 3% of your equity allocation on entry. Overlooked stocks reprice in step functions, which means drawdowns of 15 to 20% are normal even when the thesis is correct. Position size is what lets you hold through that. Third, set a written invalidation point for each, the specific event or number that would prove you wrong. For AVAH, that's a major adverse Medicaid rate decision. For KMT, ISM rolling back below 50 for 2 consecutive months. For TG, segment margins turning negative. For MAX, a guidance cut. For DOO, consumer confidence falling sharply. A thesis without an exit is a hope, not a plan. Write your invalidation points down today before you place the order. 5 names, 1 idea. Crowds price the headline, cash flows pay the bill. Aviana is mispriced for reimbursement fear, Kennametal for cyclical timing, Tredegar for undercoverage, Media Alpha for a recovery the models haven't caught up to, and BRP for a consumer cycle still in its middle innings. Next video covers which sector rotates next, the one most retail investors will only notice after the move is half over.